and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am still the Inflation Guy, and I am still your host. And we're going to talk today about some recent research that the Federal Reserve has done, a couple of both the Board of Governors and the Dallas Fed, and what it means about inflation. But first, just a general comment of kind of where we are in inflation and I guess in the market generally. We're in an era now of a very confusing inflation signals, confusing growth signals, war and pestilence, or at least war. And yet most markets recently have been somnolent. We've seen 10-year interest rates, for example, have been in a range of 4.20 to 4.40 for about a month and a half, and between 4% and 4.5% for more than a year. Gold dropped violently 2 weeks into the Iran war, but then recovered and has been like between $4,600 an ounce and $4,900 all month. Even oil has been kind of surprisingly quiet considering what's happening in the Straits. We had the spike, but then spot West Texas Intermediate crude has been set between $90 and $100 basically every day since March 12th, except for one day when it spiked to 110 and one day when it dropped to 84. But all the rest of the time, it's kind of been hanging out in this in what is a really narrow range considering what's going on. Retail gasoline jumped from $3 to $4 in March, but then in April, it's been in a range of $4 to $4.19. Kind of the national AAA average retail gasoline. Dollar euro has been 115 to 119 since last June. Equities. Okay, well, stock jockeys are crazy. Equities they sold off and then they've spiked to all-time new highs, and they're going nuts, and it's kind of weird. But most markets have been really quiet, and the quiet energy markets are, to me, the most amazing. You see people writing about how, there's going to be, the fact that we're losing production for so long, 10 million barrels a day or whatever it is that's not coming through the Straits, that effect accumulates the longer it goes on. You start to run through inventories, especially on the Pacific Rim, and but eventually that you would think that would have not only a big effect on spot prices, which it is in like jet fuel and some things, but you would expect it also that you'd see some of the deferred contracts, not just the front contracts. You'd expect to see the front contracts, frankly, for oil a lot higher than they are. I mean, I'm shocked. But also you'd expect to see some of the deferred contracts. The curve is very backwardated right now with forward contracts much lower than spot. You'd expect that to sort of start to flatten out as we are starting to do enough damage to the amount of supply, and that you would think it's going to take a long time to recover. I don't know. That it's surprising, and sometimes when you have markets not doing a lot, it means there are big forces kind of pushing each way, like there's a big tug of war. I've seen this a bunch of times in my career, and then eventually one side wins, and just like in a tug of war, when one side wins, all of a sudden the other side kind of goes flopping in the mud, and the whole thing goes screaming to one side. And there have been markets like that that I've seen many times in my career where, boy, this could turn out to be a really bullish thing. The economy is really collapsing, so bonds are going to fly, or maybe the economy is doing better than we think, and so bonds are going to go down, and so we'll kind of be in this uncertainty mode. But a lot of force on a lot of players on both sides. But I think this is the other thing. This feels like no one is grabbing the rope. No one's playing the tug of war. It's just sitting there on the ground. Conviction seems to be very low. And so instead of the tug of war situation where conviction is very high on both sides, conviction seems to be very low. There seems to be, and I don't have any numbers to put to this. This just sort of seems, and some of it's anecdotal in what you read, it seems to be much less strident on both sides of most of the market-related issues, except everyone, believes that stocks should go up, forever. So, so when this sort of market happens and you have a low conviction market, what you want to start looking for, what you want to look for is when various markets begin to align and they all start telling the same story. So right now they're not doing anything. They're not telling any kind of story except for stocks. But stock jockeys are crazy. But everything else is kind of like saying we don't really know what's going on. We don't know what the next, is oil going to go to 150 or is it going to go to 50? What's going to happen to the dollar? What's going to happen to rates? What's going to happen? All of those things seem to be just floating around in the middle. And so what you want to start to see is when markets kind of generally start to make a move that is at where a consistent story can be told across the different markets. Now, I'm noticing that 10-year inflation swaps just rose to 2.53%, which isn't super high, mind you. It's lower than it was in the middle of last year, but that's the highest since October. So, is it a breakout? I don't know. I'm not sure I'm really willing to call it that yet. And I'm not seeing that in any other markets. But if you start to see rates going higher, if you start to see stocks running into trouble, if you start to see, you start to see these things rhyme a little more, then maybe we're going to get a more significant move. And maybe it's going to have to wait until the war in Iran is over and we have sort of some resolution, and then we can sort out what the resolution means, but we'll actually know what the end point is. So I'm keeping an eye on all those things. I do feel, and again, this is going to get to anecdotal data, I do feel like there's starting to be more concern in investing circles about the idea of persistent inflation, except for the stock jockeys who are crazy. I'm likely reading too much into my consulting project flow. It's just anecdotal data, and it's a small number of anecdotal data points. But, there's some, at least there's many years of looking at this flow. In 2021, I thought my ship had come in. You had inflation going up and like, oh my God, inflation spiked and everybody's going to start calling the inflation guy, and very little happened. Investors at the time seemed to buy the transitory horse pucky. And by the way, when I typed this into Microsoft Word, it didn't flag horse pucky as a misspelling. Horse, P-U-C-K-Y. Okay, so just go type that into Word and just see. But it didn't flag that as a misspelling, which I find funny. But anyway, everybody thought there was or the investors seemed to buy the transitory story, even though it didn't make a whole heck of a lot of sense. But they didn't know what to do anyway, and so no one was doing anything about it. So no one was offsides relative to their peers. And so, I didn't get a lot of calls. But then we had the Ukraine spike, Putin's price hike. And there was more concern, but people seemed to look through it and, they thought it wouldn't last very long. It's been around a while now. And only realized later how many knock-on effects there were, like grain prices and, neon and so on, and so again, I didn't hear from anybody when that all happened. But this time, it almost seems like it's the straw that broke the camel's back. 3 spikes in inflation in 5 years. Maybe it's not a trend in inflation, but it's a trend in inflation volatility. And suddenly, I'm having conversations provoked by others that at the level I haven't had in 20 years. People calling up and wanting to get insight about a project design, or modeling a particular project, or speaking to an investment board or whatever, and that it really has not happened in a very long time. I do think it's right, though. I think it makes sense that the trend in inflation volatility has been broken, and because there are lots of big secular moves that are going to tend to push inflation higher. And there are some other things like AI. I don't believe AI is going to keep inflation down, but there are some things going the other way. And so there's going to be this volatility, and there's potentially a change at the Fed. There is going to be a change at the Fed, but there's potentially a change to a chairman who understands, that money causes inflation. And so maybe that changes things. So we're going to be in a period here where I think we're going to be in the mid to high threes of inflation. But we're going to have more volatility than we've seen in a long time. I don't know if we're going to have a long tail event to the inflationary upside. We do know that inflation does tend to have long tails to the upside. When inflation goes higher, it tends to go a lot higher. I don't know if we're going to get that again, but I do think we're going to stay in this mid to high threes, but with more volatility around that. So recent somnolence in the markets notwithstanding, or maybe that's reinforcing the point. It's a new playbook. People don't know how to deal with it. So, what do I do with inflation volatility? Is this a tactical allocation, or do I need to think strategically here about changing the way I look at portfolios? Let's get the investment committee together. Maybe the inflation guy can address them and give some thoughts or whatever. Now it's happened enough that people are like, yeah, maybe I should take a look. So 5 years. 5 years is sort of the magic number. It used to. I know when TIPS first came out, we and they didn't get they were very, very cheap, real yields above 4% and all that stuff. And the consensus at the time was, you really need 5 years before TIPS get included in kind of major asset allocation indices and they get broadly accepted by the investing community. And that's exactly what happened. About 5 years in was when TIPS finally got accepted. So maybe that's now we're 5 years in and people are accepting the inflation volatility. Speaking of long tails to the upside, the Fed Board of Governors recently put out a research note, and there's a link in the show notes, entitled, "Is the Inflation Process in Advanced Economies Different After the Pandemic?" It's a quick read, but the summary is this, in their words: the historical relationship between aggregate CPI inflation and diffusion indices measuring the breadth of inflation has weakened, particularly for the lower tail of price changes. I'll explain what that means in a minute, but I have to give some credit here to the Fed, which is rare that I do that. But for decades, the Fed's thoughtfulness about inflation and inflation modeling and forecasting was something between absent and abysmal. They had one guy, Daniel L. Thornton, who would write about money and write provocative articles like, why, money causes inflation and interest rates don't, things like that. But to be fair, inflation was low and somewhat stable for a quarter century. And so modeling inflation didn't give you anything useful. It was all noise, no signal, so you could fit any model that you wanted to. It was that period that is what led to the idea that grounded inflation expectations had killed inflation. Well, that, and plus there's kind of a sort of discontinuity in 1993. But pretty much anything which flatlined from, 2000 to 2020 had a high correlation to inflation. T-bills had an amazing correlation to inflation because, they didn't do anything. Anyway, now that there has been something interesting happening with inflation, and it has been 5 years, the quality of the observations at the Fed is getting marginally better. I still don't think they should set policy on the basis of their terrible forecasting models, but at least they're showing some signs of understanding how inflation dynamics work better than they had historically. And so this observation that the Board of Governors researchers made is something that I've spoken about in this podcast before, again, for years. In periods with rising inflation dynamics, where inflation is gradually rising, and there's a reason to think it's rising. So the underlying dynamic of price setting is rising. Then you tend to see long tails appear to the upside of the distribution. That is to say, if you put all the categories in a chart, all the categories of CPI, and you put them on a chart on the basis of their price change, you'll get something that looks like a bell curve. It's not a great bell curve, but over time it'll be bellish. You'll get a cluster that obviously, has kind of a hump around the mean. And the cluster, the overall, if you add them all up, of course, they'll average to the mean. That's what a mean does. But it's not going to be symmetrical. It's never symmetrical. But in inflationary periods, you'll have the long tails, right? So you got this bulge in the middle, and you have a tail to each side. And in an inflationary period, the longer tails, the outliers that will tend to pull the mean higher, are on the upside. So maybe your tail to the upside is 4% long and your tail to the downside is 1% long. And so those two tails don't offset. It pulls the overall mean higher, which means that there's an increased tendency in those periods for the average, the regular CPI that you get, which includes those tails, to be higher than the median, which does not include the tails. In disinflationary periods, those longer tails tend to be to the downside, so that the mean tends to be below the median. And for a very long period of time, that we've had more disinflationary periods than inflationary periods. So the Board of Governors is saying in this article that the long tails seem to be more on the high side recently. They're right, and it's a reason to be suspicious that the disinflationary period has resumed. And in case you thought that the various Fed researchers don't speak to each other, there was a Dallas Fed research piece by Tyler Atkinson, Jim Dolmas, and Rebecca Zarutsky, also a link in the show notes, that pointed out a very good reason to not get excited about any deceleration in trimmed mean inflation. Okay, this is beautiful, actually. This is actually really beautiful. So it turns out that trimmed mean, so you would think, what does trimmed mean, right? So you would think it's something like, you basically take the distribution that I've just described, you just chop off the upper end tail, chop off the lower end tail, and then just take the mean. Okay, so the median takes 1 point, right? So the median says, we're just going to add these up till we get to 50%, and wherever that is, that's the median. Trimmed mean is a little bit, preserves more of the underlying information by just chopping off the tails. But here's the funny part. Okay, and I got to say, I knew this once and I had totally forgotten this until I read this again. Trimmed mean cuts 24% from the bottom and 31% from the top because from between 1977 and 2009, which was the period over which they sort of trained the trim mean, the tails on the upside were longer, and so they wanted the trimmed mean to look more like core, so they had to chop off more of the top. Gee, I can't figure out why people think the government wants to manipulate the price index to show a lower number. Can you? I understand, it's the bow tied set, it's the pocket protector set, it's the pointy head guys who are saying, well, we believe in the mean CPI and we want the trimmed mean to kind of look like it, so we have to make sure that we chop off enough. So it's just a stupid thing to do, to be honest. But anyway, so when the tails start moving from the middle to the top, it doesn't have the same impact as when price changes move from the middle to the bottom, because they're more likely to be excluded if it's a long upward tail. Really? So trimmed mean is biased. It's specifically and intentionally biased to be low, which I think is just hysterically funny. But anyway, so the humorous thing, by the way, so it's a good article that points out that there's this sort of systematic bias. And obviously anyone who, and like I said, I knew this once and I had totally forgotten about this because I don't follow trimmed mean. I remember that I chose median and I'd forgotten why I chose median as my forecast target. And one of the important reasons I didn't choose trimmed mean was there was this kind of wacky thing about it. But it was many years ago that I kind of decided on median. I haven't paid a lot of attention to trimmed mean since then. But isn't that hysterical, right? So that's one of the reasons that trimmed mean is anyway. So it's one of the reasons that why when trim mean starts to move lower, the researchers said, maybe that doesn't mean as much as you think, because it means, we're just counting more of those downward tails than we should relative to the upper tails, which is a good point. The humorous thing about the article, and again, I want to give credit to the Fed for actually thinking about these things. I mean, at some point around 2009, they actually defined trimmed mean to do this. Okay, so let's not give them a whole lot of credit. But the fact that they're now looking at that and saying, well, gee, this has weird implications, I think is they should get credit for that. But the humorous thing is that in the article, the researchers still think core inflation should return to near 2% by 2027, partly because, and I quote, housing services inflation can be expected to continue to slow towards market rent measures. Now, I've already covered that a lot for the last couple of years, why that's wrong, and I'm not going to talk about it again here. Barclays also covered this recently. I think I had a podcast, or maybe it was in my blog, but I talked about how Barclays mentioned this, and it's something I've been talking about for a couple of years. So the Fed's analysis is improving, but maybe they just need 5 years of learning. Maybe 5 years is the magic thing. So in 3 more years, the Fed will understand why shelter CPI does not converge to market rent measures. Patience, grasshopper. We must have patience. But this is all the more reason why you should not feel strongly that the Fed should act aggressively on their models, because their models, it takes them a long time to learn anything. And if it takes them 5 years to figure out what's wrong, I don't really want them acting today. They're a good research shop, but I don't really know about actually managing the economy, which of course gets us into the nominee for Fed chairman, Kevin Warsh, because he seems to have a similar mind there, and I respect that. I will have a piece on my blog next week about what I think about Kevin Warsh, and it's positive. But that's all for today's podcast. Please like and subscribe. These don't happen on the same cadence they used to, but it's still worth a subscription, and refer other people, whether it's this particular podcast, this particular episode, or the podcast generally. I like it. I appreciate it. You can contact me at inflationguy@enduringinvestments.com, enduringinvestments.com. Subscribe for free to the blog. That's at inflationguy.blog, and you can follow me on X at inflation_guy. Visit Enduring Investments if you want to contact me, or if you need help with diagnosing and treating an inflation problem. But remember, defend your money. And if inflation is coming for you, remember, you know a guy.